Schwab Advisor Services is a proud supporter of the RIA Edge podcast and independent financial advisors like you. When it comes to your independence, Schwab Advisor Services is all in. They provide industry-leading custody services with no AUM minimums, no custody fees, and digital onboarding for starters. With Schwab, you'll be backed by some of the most passionate folks in the industry with over 35 years of experience helping firms of all sizes. To learn more about everything Schwab can do for you, visit advisorservices.schwab.com. Hi all, and welcome to the RIA Edge podcast. I'm David Armstrong. This week we are at the Wealth Management Edge conference in Boca Raton, Florida. There's almost 2,000 folks here, half advisors, half from the broader wealth management ecosystem, talking about growth, whether that's leveraging better technology, better investment solutions, focusing on decision makers at RIAs make the kinds of decisions they do, which is, of course, the theme of this podcast. So today we are speaking with Michael Henley, who is the CEO of the $1.5 billion Brandywine Oak Private Wealth, started by a group of breakaway brokers from Merrill Lynch. It's a young team, it's a very ambitious team, and a team that is grappling right now with the kind of big decisions they need to make to get to their next $1.5 billion or $3 billion or $5 billion. As I say, they're an ambitious team. Michael's incredibly thoughtful about the approach, as I think you'll hear. And with that, here is Brandywine Private Wealth's Michael Henley.
Well, first of all, Michael, thanks very much for joining us on the RIA podcast.
Thanks for having me.
And thank you for your kind words about the Wealth Management Edge conference. I'm glad you're finding it useful.
Had a blast.
That's great. For the folks who don't know, tell us sort of give us the 101 on Brandywine Oak Private Wealth, where you came from, where you're at now, your size, clients, et cetera.
Sure. So I'd say we are recovering advisors from Merrill Lynch. So we were a big Merrill Lynch team in Wilmington, Delaware. Kind of all of us are legacy, kind of the core 8 founders, kind of started off at Merrill, all kind of never went anywhere else, our only firm. And in 2018, we just got to a point where we felt that we couldn't really give conflict-free advice working inside a big bank. So it's one of those things we kind of decided to launch our own firm in 2018. So we launched Brandywine Oak Private Wealth in 2018. At that point, we were about 800 million, 900 million of assets for clients. So we moved clients over in 2018. Since then, the firm has grown pretty substantially. We're about a 1.5 billion now. We went from eight total members of the firm to about 16 now. So it's grown quite a bit. We work with mostly individuals and families, so no corporations, none of that stuff. So mostly individuals and families, helping them plan and manage all aspects of their finances and investments. So it's everything from their tax situation. We have an obsession, I'm going to call it, Dave, with tax. It's something that we just did even back at Merrill. We felt where we can really move the needle the most for wealthy families is around their tax situation. So in light of that focus, in 2021, we kicked off a tax preparation side of our business. So we have a tax practice as well. So all of our clients, most of them do their taxes. We do their taxes for them. We file the returns for them. We do their quarterly tax payments in-house. So we kind of take that, we lift that off their to-do list, if you will. And yeah, it's been a lot of fun. We've had a blast along the way, and
That's great. Yeah, there's a lot to talk about there. The first one, I guess, would be when you left Merrill Lynch, your decision there was that you were thinking you could not do as much for your clients as you could maybe on the independent side. Did you have a partner there? I know you were in the Dynasty network for a bit.
We did.
Tell me a little bit about how that's lifting the team out of Merrill Lynch and how that worked.
Now, Dynasty was a great resource for us. They essentially helped us get from A to B. It's a lot to undertake on your own, as you might imagine. We had an 8-person team back then, and we had a couple of advisors who were later in their careers, I'm going to call it, who were a little bit more hesitant to leave after 30, 35 years of service at Merrill. Just in speaking with them and saying, okay, we can kind of give better outcomes to our clients, give more objective advice, have more resources, really shop the street on behalf of our clients. They kind of saw, okay, if our team's going to be happier on the other side, on the independent side, if you will, they were very supportive, especially in light of the fact that from a retiring advisor's standpoint, for ordinary income versus long-term capital gains, of course, was much more flexibility. They're both still involved with the firm. We kind of set up a 10-year installment sale for them on the independent side, where at Merrill, it was like a 4-year sunset. It is what it is, 4 years ordinary income, and you're kind of out at that point. It was important to us that our senior partners who built the firm in the first place, or brought in a lot of the original clients, had ultimate flexibility on how much they wanted to stay engaged, the clients they wanted to continue to work with. So there was no forced exit date, if you will. So Dynasty was instrumental in helping us get out of Merrill. And we kind of used Dynasty as a platform provider for a number of years. They were great, no issues. And then we got to a point in 2023 where we said, okay, let's try and go about this on our own. And then we ended up being separated from Dynasty 2023, and we've been, off to the races ever since.
Was that just a matter of you got to a point where the Dynasty it had done for you what it set out to do for you, and there was no need to continue with that? You felt like you could have access to the resources on your own, or was there another partner that was brought in?
No, actually, we did it on our own. It's a great question. So we ended up in 2023 deciding, okay, we can go ahead and continue. We got to a point where once we got to the independent side, we just really enjoyed kind of the business ownership aspect of it in terms of, doing all this stuff on our own. We got very used to doing things on our own. So nothing bad to say about them whatsoever. I think they're pretty much the only or one of the best options for advisors looking to leave the big wirehouses, and they don't want to do the heavy lifting. They don't want, I'm going to call it the brain damage of trying to do it all yourselves.
Yeah, for sure. I noticed that in addition to obviously the blocking and tackling, financial planning and whatnot, on the investment side, you do have for clients some private placements, some structured products. You do have access to those investments for your clients. So one of the things that we always used to hear anyway was that something that was keeping advisors back inside the wirehouses was that there was not as readily available access to the broad array of those kinds of products outside the wirehouses. Is that changing? And how are you finding some of these more non publicly traded investment options for your clients? What are you using to pull those together?
It's a great question, David. I would say that so first and foremost, I think it has changed a lot. I would say back, even when we were leaving Merrill, I think it was this misnomer that, gosh, you're not going to be able to do structured notes. They're not going to be transferable to Fidelity or Schwab, wherever you decide to land as your custodian. They were all fully transferable, no issue there. All the private investments, we didn't use any proprietary private investments through Merrill. But I would say that it's pretty much open architecture these days. Our chief investment officer, Peter Kim, really sources pretty much all of our private investments, mostly evergreen structures. So on the private equity side, private credit side, private real estate side, all, I'm going to say pretty well-known names. Nothing is too exotic for clients, but it's really fully accessible. Now with iCapital, I mean, you have pretty much the same open architecture that you have inside of a big firm. So no issues there. I would also say something interesting on the independent side. I'm happy to talk about this in further detail if you like. In 2021, we decided to add, for clients who were open to it, a small sleeve of crypto assets or digital assets, if you will, Bitcoin and the like, in 2021. And it's something that we would have never been able to do back then inside of a large commercial bank, as you might imagine.
Sure.
That was something that clients were very receptive to. Not every client, of course, they had to have a certain, risk appetite, 0.5%, 1%, not a large allocation. But clients who were open to it, we would buy it inside their Roth IRAs at Fidelity. And that's something that, was a complete home run looking back now. And they were early and they really trusted us, but something that really has been a huge home run for clients.
That's amazing. Was that something that clients were demanding of you, or was it something that you brought to them as a service that you thought they would be interested in, or some might be interested in? In other words, what tipped your decision to wade into those waters?
The catalyst was actually at a conference. I don't know if it was, it may have been the Edge conference, actually. I saw Matt Hogan speak from Bitwise, and he said, look, the technology, you can't argue it. The direction this is going, the technology let's not I'd rather be, directionally right as opposed to precisely wrong. I totally agree with it. We're big index fund investors. So buy the market. Don't try and pick a horse. Just bet the entire stable, if you will. So he said, hey, index this allocation. Don't try and pick a horse. Don't try and pick Bitcoin or Ethereum. Buy the index. And we just said, it's our duty as fiduciaries to educate our clients on what's out there in terms of what the technology is now looking like. The blockchain technology is hard to argue with. And we said, okay, we're going to present it to clients. And basically in the fall of 2021, so let's just educate clients on the technology, what it means, kind of what Bitcoin is as an asset class, if you will. Let them make an informed decision. Some clients said, hey, we want nothing to do with it. Fine, no issue. But at least we wanted to educate them on what is out there and kind of how it's not going away. It's one of these things that back then it was still early stages or earlier stages. But no, clients weren't really asking about it at all, if I'm being honest. But we were very honest with them. Hey, it's a 10-year bet. We're not trying to do a trade and 6 months later get out of it. So it's something that, invest 0.5%. And if it goes up, if it triples in value, we're going to trim it back, kind of trim the gains, lock in the gains in your Roth IRA. But it's something that I would say at this point, I would say directionally, about a third of our clients probably have exposure, maybe a third to half. So it's still not every client. Some clients still are like, hey, we're good without it, which is totally fine.
And for those clients who do have it, you have a recommended allocation of 1.5 or I'm sorry, half, maybe to
0.5% to
1%.
1%, yeah, somewhere in that range. And we kind of have parameters around when it exceeds, 2%, for example, we're going to trim it back. So kind of just guardrails in place to make sure it doesn't get too sizable a position, recognizing that there is higher volatility with it, of course. So it's kind of in that growth bucket of assets, if you will.
Sure. Another thing that your firm did that I think is kind of unusual, you've alluded to it already, particularly a firm of your size. We hear a lot of RIAs talk about, tax planning is certainly something we do, but tax preparation is not.
Yeah, it's a great question.
You've gone into tax preparation as well.
We have, yeah. So it's interesting. The catalyst for that, Dave, was actually in 2021. We did our first tuck-in. So Lisa Quadrini joined us. She was an advisor out of Wells Fargo, South Carolina. She's based out of Kiowa Island. And we lifted her out of Wells Fargo in 2021. She joined. And what we found was we had about 60 new clients from Lisa that all had, I'm just going to say, tax issues. They either had CPAs that were either retiring or that were just missing the mark relative to the actual execution of their returns in terms of filing them. So we had to amend a lot of returns. So we said, okay, we went to our lead CPA that we worked with on the outside, his own CPA firm, Chris Smith, and said, look, we can send you 60 new clients. So basically get ready for a lot of new clients, or we can do something together. And he is our age, he's 40 years old. So we said, let's do something together. And that's been, incredibly well received. It's interesting. We didn't know what to expect. When we emailed out in 2021, we're starting off our own tax practice. We weren't sure how maybe if we can get 10, 20% of our clients to join the tax practice, that would be great. We had about half our clients sign up in the first 3 months. So half our clients said, look, sign us up. We don't want to be involved with an outside CPA. And the big benefit to clients is that they're out of the middle position. A lot of our clients felt as though they were in the middle between their CPA and their wealth advisor or financial planning team. And in terms of coordinating and making sure things that we actually did on their side, on the tax planning side, actually got reported correctly. Because if we could have the best tax plan in the world and best tax strategy, but if it's not implemented relative to the actually filing of their tax return, it doesn't do them any good. So we'll often, with new clients, we'll often spend time reviewing the last 3 years of returns to identify errors and kind of go back and amend their returns and get them hard dollar refunds back. The things that were either missed by their CPA or what have you.
That's great. And then assuming there's a separate charge for that. I think I noticed in your Form ADV, there's obviously the AUM charge for investment management, and yet a flat fee for planning and some of the other services that you offer?
Great question. So we basically we charge an AUM fee for all clients. For certain clients who are more, I'm going to call it do-it-yourselfers, that really they know they need a professional involved for their spouse more often than not. We'll charge a flat retainer. So maybe they stay in charge of the investments. We do all the tax planning and estate planning on their behalf. But this way, if something happens to them, I'm going to call it the one spouse that's more of a CFO. The other spouse is well taken care of. They have a relationship with the firm, et cetera. On the tax preparation side, we, for the most part, the client will pay a separate invoice for the tax preparation services. But for clients if new clients come in and they're above a certain dollar amount, they're larger clients, we're going to cover the tax preparation as part of their AUM fee. We'll also cover the tax preparation oftentimes for their kids, for their parents, because as you might imagine, Dave, on the intra-family gifting and planning side, if we can do, the client's taxes in-house, do the kids' taxes in-house, and the parents' taxes in-house, you can really get creative on how do we minimize taxes for the entire family. Do we gift, appreciated assets upstream to mom and dad, have them, pass away with the assets, so it steps up in basis down to the kids? Do we gift appreciated assets down to the kids that may be in a low tax bracket to avoid capital gains taxes if their income is low enough? So you can really get creative. It's difficult to do that level of planning without actually doing the taxes in-house. We've done it years past with an outside CPA, and it ends up being a lot more to undertake. You're not really in control of the family's entire tax picture, if that makes sense.
Yeah, no, it makes total sense. And I imagine that does give rise to some interesting and potentially creative, ways to disperse some of that. Going forward, estate planning, is that something that I know it's something you offer? Is there lawyers on staff, or do you at this point still go outside for estate planning services or partner
That's a
for estate?
great question. Yeah, so it's interesting. When we launched our firm, one of the attorneys we worked very closely with, Matt D'Amelio, he actually left his large law firm and kind of formed his own shop, just like we did. It's very interesting and kind of good timing. And so Matt's firm, Matt D'Amelio, we formed a formal arrangement with him in 2018-19 to essentially do all of our clients' estate plan reviews in-house. So we cover for clients an estate review, usually every other year, give or take, depending on the law changes and what have you, where he'll basically take the client's existing documents, summarize them in PowerPoint, kind of go through an hour meeting. Okay, here's what you have. Here's what your estate plan says in English today. Here's some considerations, around gifting, around titling of your rental property, around, who your trustees are, et cetera, et cetera. And they can decide, do they want to engage Matt after that to get their estate documents updated? They can choose to go with their own attorney. If they're not in Delaware or Pennsylvania locally here, we'll often work with their outside counsel. And it really helps save the client a lot of back and forth with the attorney. I'll use an example. If a family's in Florida, he'll review the documents and say, okay, here's the amendments I would make to the trust, and here's why. They'll go to their outside counsel, kind of, here's the changes we want to make. They'll get drafts, of course. The clients will get the drafts from their outside counsel. We'll then take it to Matt and have him review it. Okay, any feedback? What are things that they should be looking out for? So he really kind of serves as an objective third party for clients who are out of state.
Do you foresee a time when maybe you'll bring that a little closer in-house?
It's a great question. Never say never. I would say right now it's great having him as an outside counsel. I can see the pros and some clients have asked us, can we serve as trustee for their family's estate plan? We haven't gone down that path quite yet, but I would say never say never. We're always looking for the how do we add more value to families?
Sure. And some firms are toying with the idea of bringing, the trust bank in-house. Yes, the institution to actually hold the assets in-house as well. And I think there are some white-labeled trust services that can be pretty easily brought in-house. Is that something you're exploring at all, or?
We are always looking. So it's something that I think as it gets more and more available to RIAs, to independent firms, I think it's something we'll continue to look at. And just by way of example, wealth.com has a fascinating offering. We haven't fully engaged with them yet, but we continue to look at their software, just the ability to summarize clients' estate plans, almost like a ChatGPT for your estate plan. Summarize what it means in English is just so incredible, especially for clients' kids. We often find some of the gaps. A lot of times our clients will have estate plans, or new clients will have their estate plans at least done at some point. A lot of times their kids just have no estate plan whatsoever. They often have young kids. It's just something that's not on their radar. So the wealth.com offering relative to creating your own estate plan is certainly fascinating for the next generation.
Yeah, for sure. It strikes me that you're at a point here. I guess Michael Kitces calls this sort of like the dangerous middle ground in the growth story. It's I guess it's pretty easy to kind of come up on a wall there. Are you thinking about your next phase of growth? And you've done, obviously, you brought some advisors in, recruited some advisors. I don't believe you've done a full-on acquisition of another firm.
Correct.
Is that something you would consider, or what are you thinking about going forward? What's your future growth plans?
It's a great question. I would say that we look back at Lisa, the type we did in 2021. I mean, in a perfect world, we would do a Lisa type of transaction every couple of years. Just an advisor who's close to retirement but not quite retired, oftentimes inside of a big wirehouse that really believes the kind of planning first mentality that we believe. Organic growth, of course, is always kind of the lifeblood of our business. But on the M&A side, I think adding a tuck-in of that sort of nature, we can kind of increase the level of service they were getting. All her clients have kind of gone up dramatically in value in terms of what they're getting from their advisor and team. From our standpoint, it's a home run. So we can kind of leverage those relationships with our next generation of advisors. It's interesting. We've really intentionally built the firm with advisors who are in their 30s. So even though our kind of core founders now are in their 40s, we're very intentional. Okay, that we're not going to be, we're no longer the young kids anymore. I hate to say it. We're kind of the middle-aged generation. I hate to admit that, but it kind of is what it is. So it's one of those things where the more we can train the next generation on planning, all that good stuff, I think you have to have more than organic growth. I think for us to scale up to $2.5–3 billion, I'm in agreement with Michael Kitces. I think it's a dangerous middle ground. I think you have to do a combination of both organic and inorganic growth because quite honestly, it's difficult to get to from 1.5 to 3 billion to double again without M&A. It's almost
Yeah.
one client at a time. It's no matter how
Yep.
fast you grow, it's a big overhaul.
Yeah. Yeah. And it gets harder and harder the bigger you get, right? That
Yep.
percentage aggregate becomes a little harder. Yeah. Do you and your partners have agreement that that is your ambition though to grow? It's that you are looking for that kind of next phase to get above that dangerous middle ground?
It is, yes. It's a great question. So I would say that we're very aligned on, we're all about impact. So the only way for us to help more families is to have, more advisors, more clients, larger impact. So for us, we absolutely want to get 2.5, 3 billion in the next 5 years, I would say directionally. The question really becomes, do we need a growth partner? And what I mean by a growth partner is when it comes to M&A, adding advisors, you have to have capital. So it's something that, one of the things that was a benefit of working with Dynasty when we were with them was we had this kind of, I'm going to call it investment bank for lack of a better term. When we added Lisa, you had immediate capital. We had no need to go out and source financing. So that was kind of a benefit of being part of any of these platform providers, whether it's Dynasty, Sanctuary, any of them. You have this immediate access to capital. Something that we are continuing to explore is, okay, for this next phase of growth, does a growth partner make sense? Does that mean joining a platform? Does that mean a partial sale? There's a bunch of different options, ways to explore that. But having a growth partner to help us scale to the next, big phase. Because what's important to us is we don't want to get it wrong. I think going from 1 to 1.5 billion is one thing, but to go from 1.5 to 3 billion, or from 1.5 to 3, then to 5, and in let's just say an M&A opportunity that's not properly executed can really be an issue. Where if you're a big wirehouse team, you add an advisor, it doesn't work out, you're going to part ways. They're still at the same firm. There's no issue. If you do an M&A tuck-in and it's not a culture fit, or you make a mistake there, it can be much more difficult to unwind.
Yeah, for sure. And given the time commitment that it would take for you to dive into making all that happen, that's a big, I guess, opportunity cost for other things you could be doing.
Exactly, 100%. That's exactly right. Yep.
And you say that you're a team of middle-aged leaders. I would have to. I mean, the advisors are. What's the average age of the RIA? Is still kind of, I think, north of 60. So it's a fairly young team.
It is. Yep. All things considered, we are very young. We probably have a 15-year runway ahead of us easily, which is exciting.
Yeah, that's great. Tell me then a little bit more about some of the other partners you work with. You have your own chief investment officer on staff. Is there a particular TAMP that you work with, or what does the tech stack look like there?
Tech stack we are using, so let's just see. So if I break down the leadership team, we follow EOS, kind of tried and true. So I'm the visionary. I'm like a squirrel, next shiny object, next. The brains of the operation, I like to say, is Allison Dorsman, my co-CEO. She runs the firm pretty much entirely. So she's kind of the brains of the operation entirely there. Peter Kim on the investment side is our chief investment officer. And then Brittany Kowski, our chief compliance officer. She's also almost a COO, if you will. And then Deanna Palucci just got married over the weekend. Different last name now, but basically she is our director of marketing. And to answer your question, Dave, on the technology side, we are big e-money users. So e-money on the planning side, Tamarac for reporting and trading as well. We trade through Tamarac as well. Holistic Plan, of course, for tax. CRM, we switched to Wealthbox about the last 12 months, I would say, give or take, about the last 12 months. Unbelievable. I mean, unbelievable. I had no appreciation, or I had very little appreciation for how effective a CRM can really be. And Wealthbox has just been an absolute game changer. I can't say enough about it. Really helped us, really upgrade or level up our game relative to client data, which is, critically important. We also added Jump AI in the last 6 months. Something that, I think we were all, it sounds crazy. We're not curmudgeons, but we're 40 years old. So we say, oh, AI, do we really need it? We do a great job taking notes in meetings. And I have to say, I'm sure like most advisors, Jump AI has been night and day. I mean, just being so much more engaged now in client meetings because you're not taking notes. You're literally, the whole thing is summarized for you, is a game changer. I would say it's the next wave of efficiency, in my opinion. The next 5 years are going to be, how do we maximize advisory efficiency? I've always said that kind of, how do you define a great leader? A great leader is getting full capacity out of the people you're leading, right? And that kind of that AI technology aspect of it, if we can really say, okay, we can actually cover more clients now and give more wealthy families outcomes to what matters, because we're not spending 3 hours after a meeting typing up review notes, because it kind of does it for us to a large extent. I think that's just a huge step in the right direction for our entire industry.
Yeah, no, for sure. And it's this notion of efficiency, creating room for growth is an important one. And then keeping the personalization there with the client still.
Yep.
And that's
Yep.
always the tension, right? Between that personalization and scale. That's a tension that just is constantly resolved, I think.
Yep. That's very well said. Agreed.
Now, let me ask you this. If as the leader of the firm, I'm interested in how you make decisions about growth in terms of internal resources. So if your marketing person said, I'd like to hire out a marketing team, your investment person said, well, I'd like to hire out an investment team. And somebody else said, well, we need to hire out more junior advisors or whatever it might be. How do you decide which of these areas to go to first in terms of growth? What will be the thing that will lead you to believe, well, marketing is the place where we should devote some resources out of our limited amount of resources that we can devote this year? We're going to put it to marketing and not the investment team, or we're going to put it here and not there. How do you make those decisions?
Believe it or not, what's been incredibly helpful for us, Dave, is actually having just great outside consultants. We have Carolyn Armitage basically on the consulting side. She has been instrumental. Race Clifaldi from ClientWise, just having these really effective coaches that have basically seen every aspect, every dimension of an RIA you can possibly imagine. Kind of, okay, when are we at those crossroads, I'm going to call it, where it makes sense to hire more advisors? More often than not, what we find is by hiring relationship managers, we almost get our advisor in a unique position because basically we have relationship managers that kind of are junior advisors, I'm going to call it, where they're kind of they're handling the client day to day in terms of email, in terms of they're kind of the point of contact, but they're not owning the relationship. The advisor really owns the relationship. It gives our advisor the ability to kind of cover more clients because they have these relationship managers beneath them who will handle the day to day. But actually, to answer your question, having great coaches, great consultants has been incredibly helpful.
Do you have a predicted growth rate for the next year, 2 years? I mean, markets depending, obviously, anything can happen. Who knows? But in terms of your outlook, do you have a destination you want to be in a year, 2 years, 5 years?
We do. So believe it or not, we always take we take our AUM and say, okay, if we're 1.5 billion, our goal is to add 10% of our prior AUM in the next 12 months. So if we're at 1.5 billion, we want to add 150 million of net new money every year. And obviously, it gets more and more difficult as you get bigger and bigger, but it's always kind of our goal. We want to be mindful of, okay, tax, obviously tax, RMDs, distributions for lifestyle. So kind of having a net new asset goal of 10% of our prior assets has been a pretty healthy goal. We don't always hit it, of course, but something that we always strive for.
Do you notice the tone of conversations with clients have changed over the, I guess, what is it now, the decade, I guess, that you've been outside of Merrill Lynch? If you could just reflect on from Merrill Lynch to now, are clients genuinely becoming more demanding of their financial advisors, or is it usually the financial advisor who has to tell the client, oh, by the way, there's all this other stuff we can do with you?
I think it's the latter. I really think it is. I would say this. I think the new clients come on board, and even in the last 10 years, I think it's more advisors creating services that they think the clients want than it is the client's demand. I think the tax prep was kind of an exception where clients really wanted that. But I would say I'm in a lot of mastermind groups with other advisors, kind of rock stars in the industry. And I think a lot of us feel the need to continue to deliver more and more and more and more. But it's interesting when we survey our clients and ask them, okay, what do you feel are the most valuable 2 or 3 things that we're doing for you? It hasn't changed in 10 years. It's basically give me outcomes to what matters, give me great risk-adjusted performance, and make sure you're incredibly responsive when I need you. So I think from the client standpoint, I think if we can do the tax in-house and do some of these other things in-house, great. But I don't think they necessarily are demanding that. I think some of it's more of the advisor industry, and we feel the need that we have to keep doing more and more and more.
I know some of your clients are high net worth clients, and I imagine there's ambitions to swim upwards in those waters as well. What about some of the family office services? How do you approach some of that stuff? If there's even a need yet, or things like bill pay, I guess, or concierge type services. I know some of the custodians offer some of that stuff, I guess, that you could use. But how do you think about it?
It's a good question. We haven't quite got there yet. Our bread and butter is like the I'm say $2 to $10 million space, so $2 to $10 million investable assets. We're pretty much involved with everything in their life that involves a dollar sign, right? But we're not going to walk their dog or do their bill pay necessarily yet. We do control their cash flow. I think handling their quarterly tax payments, that's kind of the closest thing that we'll get to bill pay. But we really won't go as far as, doing the month. We're not going to pay the landscaper and pay the cleaning service, et cetera. But it's something that I think as the industry continues to evolve, I would not be surprised there's a technology company that ends up making that super simple. I just don't think we're quite there yet as an industry.
It's interesting. Again, it's one of those things that I don't know that clients are necessarily demanding it, or if it's just something that advisors offer.
I think it is completely. I think it's something that I think advisors. I think we're all guilty of. We want to do more for clients, and it's great. It's great in a way. But I think as a CEO of an RIA, I think the number one thing is not having shiny object syndrome. I'm guilty of it myself. I used to go to these conferences and come back, and now I have to almost avoid the technology room, I forget what they're called now, because basically I come back, I'm like, well, what about these five different tech options? And it's almost there. My team's like, okay, we're good on tech. Not to say technology is bad by any means, but it's so easy to go down the rabbit hole. And I can say specifically to technology, Dave, clients are not asking for the latest financial planning software. They don't care if it's e-money or Right Capital. Just give me outcomes to what matters. What you do on the back end is one thing, but I think so much of it is in our heads around, well, clients have to see the latest income lab report. They have to see this. And it may be really cool for us, but clients, they just, I don't believe they genuinely want that sort of thing.
Yeah, no, that makes a lot of sense. And the shiny object syndrome, I totally understand. How about your relationship with your custodians? Are you happy with that?
We are. So we are 100% Fidelity at the moment. We are basically 100% Fidelity. We have been since day one. Never had any issues. I would say that, at the conference, I think, Joe Duran and Michael Kitts has had a great back and forth, banter back and forth on this topic, because I think it is fascinating. I think it's something that is a difficult thing from a fiduciary standpoint. From their perspective, we don't know how they're making money. We kind of do, but we kind of play this game of let's try to minimize what they actually get. They're going to tell us, our money markets now pay nothing. We're going to, buy into the money markets to pay more. So we're going to play the game to the extent that we can. I think what I'd like to see on the custodial side is just more transparency on, okay, hey, we're going to charge a nominal basis point fee for all of your, for every RIA on Fidelity or Schwab for that matter. And basically, you can choose to pass that on to your clients or pay it yourselves on the RIA side. I think the more transparency we can get to as relates to the custodians, the better. I think it's difficult to have to play these games around money markets and, e-delivery versus paper statements and that sort of thing. So I think the more transparency, the better. Yeah.
And I guess one of the things that the Fidelity, obviously, some of the other custodians make money off order flow, selling order flow. Do you think that matters to your clients? I understand if you're a large institutional investor and you're moving billions of dollars, fine. But for most of the retail clients, even the high net worth clients, are spreads and order flow really a deciding factor?
I don't think it even crosses their mind. I don't think it even comes up at all. I think it's something that is, again, it's more advisor back office, discussion, which I'm not saying it doesn't matter, but I would say to the end clients, I think clients I don't think they could care less. I think it doesn't even come up.
Yeah. But still, you would like to see some of those monetary considerations brought forward and made more transparent to the advisor, so knowing what's happening and perhaps allowing you the option to pay for services without that being compensated by some provider or some other service provider down the line.
100%. I think clients are used to just, hey, I'm paying X. They know if it's not all free to get, investments and trading, all the stuff that Fidelity offers and Schwab offers. I think the more we can have transparency on that, the better. I think all the way around.
Yeah, well, this is fantastic. I kept you here for a few minutes longer than I promised to. I apologize, Michael. And any kind of final thoughts, as you're looking out on your growth story, your growth trajectory?
No, I'd say it's truly a privilege helping families give families outcomes to what matters in their lives. I think all of us are so blessed to be in this profession. I can't say enough good about the independent side. Best decision we ever made was kind of forming our own firm and onward and upward.
That's fantastic. All right. Well, Michael, thanks very much for joining us.
Thank you, Dave. Have a good afternoon.
You too. And thank you for listening.
Schwab Advisor Services is a proud supporter of the RIA Edge podcast and independent financial advisors like you. When it comes to your independence, Schwab Advisor Services is all in. They provide industry-leading custody services with no AUM minimums, no custody fees, and digital onboarding for starters. With Schwab, you'll be backed by some of the most passionate folks in the industry with over 35 years of experience helping firms of all sizes. To learn more about everything Schwab can do for you, visit advisorservices.schwab.com.